Welcome back. Continuing with our series of corporate conversations, Aarti Drugs is the next management on the show. The company reported a weak third quarter. Their margins also came in on the healthier side, but the API segment continues to witness some pressure. To discuss this on the road ahead, we are being joined by Adhish Patil, who is the CFO of the company. Adhish, good afternoon. Thank you for joining in. You start off with the API segment, right? You also mentioned that it continues to face pressure because of pricing and because of weak demand as well. So just summarize this for us. What are the trends that you're witnessing on ground currently? Has pricing improved by any means, or has even the demand situation improved?
Yes. So mainly, if you look at the December quarter, the export demand was quite good. It was healthy, and that is why the gross contribution actually improved for December quarter in API segment. But in domestic market, the antibiotic segment did not do well, and that was the main reason why there were a little bit fall in volumes as well as far as domestic market was concerned. But export is doing well. And as far as the pricing scenario is concerned, if we look at YOY numbers, December 24 versus December 23 quarter, there is hardly around 2.5% negative price variance. If I compare with the September quarter, Q on Q, again, it's limited to around couple of percent negative price variation, and mainly on the account of antibiotic segment. But in some other products, in fact, we have also seen some upward trend in the prices. And going forward, if the sanctions on the Russian crude is implemented strongly, and if the crude goes up, then we might expect a little bit of upward trajectory in the solvent prices, intermediate prices, and hence the API prices as well.
Right. I was just hanging there. We have some comments coming in from SRF as well. They are positive on the HFC business going forward in the fluorochem, outlook at least, and the packaging film as well. They believe that this demand-supply imbalance will continue, but will soften. The stocks move to the high point of trade on that itself. But let's get back to our conversation with Aarti Drugs. Adhish, when you started the year, you were looking at 7 to 10% growth when, the prices were anticipated to fall by about 5 to 8%. 9 months of this year, your revenue is actually down 10%. And like you pointed out, prices haven't changed much from last December to now. It's down about 2% or so. Yeah. What does that do to your guidance for this year? Are you still hopeful of double-digit revenue growth this year? Looks unlikely. And what's your target for next year?
Yeah. So what happened this year was that though the prices are negative 2% for December quarter, but for the first two quarters, that is June and September quarter, the negative price variance was quite high, around 7 to 10%. And that was the main reason why the overall revenue did not do well, mainly because what volume growth we were expecting did not come. And main reason for that, we account to the export market in the first half of the year. Because of a lot of elections, the tender business was not that high. And in turn, we did not get any API demand for exporting the API. And that was the main reason. And the second main reason was our salicylic acid plant. We had commenced the plant in the beginning of the year itself, but because of the teething issues, we were not able to scale up that. And had we be able to scale up that, then the volumes would have been really good. So those were the major two factors why revenue did not do well. So as far as this year is concerned, though March quarter might do well in terms of volumes, but overall, we will see flattish revenues, as you correctly pointed out. If we look at FY26 projections, then if we considering that the salicylic acid plant will be well on track, and also the Saika plant will be coming online in this quarter itself. So both those plants operational, probably we can have healthy volumes next year, around 15 to 20%. Let's see, we hope so. There might be a slight negative rate variation of about 2 or 3% for the entire year, considering the first half of the year had better prices in FY25. So overall, probably, in mid-teens, we will try to achieve the revenue growth for next year.
Very interesting. Mid-teens is what you're trying. But you said that this year you will end flattish on a revenue basis. But that also puts a lot of pressure in the fourth quarter, because the first 9 months, your revenues are actually down 10%. So you're confident of doing flat also, which means that you'll have to grow a lot more.
Yeah. So it is definitely challenging. But the positive side is our salicylic acid plant, the teething problems are over. So that we have, first of all, I would like to point out that this process for salicylic acid was developed in-house. And that is the main reason why, it took so much time to scale up at the plant level. But finally, we are able to do it. So we have already scaled up in the month of January, and February and March, it will be go up and up. And uh, definitely it will add to revenues, but then, yeah, probably we might fall short of achieving last year's revenue numbers, as you correctly pointed out.
Now that if is a very big caveat, right, Adhish? You mentioned that you will grow at least back to flat growth on the top line front by the end of the year. What about margins? Where do you expect to end this year? And what about FY26? Because you say that you are confident of 13 to 14% margins. You're currently at 11.5. What will contribute to that margin expansion from 11.5 to say 13 or even 14 for that matter?
Yes. As if you talk about margins, so there are three main reasons. One is that because of the salicylic acid, we have been taking quite a bit of hit on our P&L. We were expensing out everything. So now that teething trouble is over, even if you do break even, it should improve the EBITDA margins by more than 0.5%. And plus, if you go in positive, then it will definitely add on to that. That is one main reason. Second main reason is the Saika plant. Now the Saika plant, that process is not in-house. So it is a proven technology. So we don't expect so much teething problems for Saika plant as we saw in the salicylic acid. And that is a backward integration project, basically the methylamines products. So that will definitely help our gross contribution, because anti-diabetic segment is almost contributing around 12 to 14% to our standalone revenues. So it's a big chunk. And plus we'll be selling those spec chem products outside at the outside market as well. And the third is the higher contribution of exports. Now we also got USFDA approval, which is a very big achievement, because we were under import alert almost 10 years now. And that was not only hampering the US sales, but also the European sales from that facility. So once we go more and more into regulated market, the margin profile is quite different than what it is in the ROW market. So that should also help us grow the EBITDA margin. So that is why we feel that 14% upwards is fairly reasonable to achieve in the next financial year.
Well, that's quite interesting, because when we spoke to the analyst on you getting that USFDA approval, they said that this plant could do revenues of almost 60 to 80 crores on a full-fledged basis. Just a final question before we let you go. You had said that formulations would double as a proportion of your overall sales. Instead of doubling, it's actually declined from the last time we spoke. It's about 8% of your overall sales. So where do you see this number going? And what happens to your 4,500 crore revenue target in 3 years, which, when you said, meant that you'd reach that number by FY28? Are you still targeting that?
That 4,500 would be slightly revised down to around 4,000 crores because of the current rates, what rates are ongoing. But if the rates goes up again, then obviously that number is still achievable. But considering the current rates, it should be revised down to around 4,000 levels at the console level. As far as the formulation business is concerned, definitely we saw a bit of hit in the December quarter. First of all, we would like to point out that even at the formulation side, we got USFDA approval for the first time for our oncology segment. And we also got UK MHRA approval for our oral solid dosage facility in the same vicinity. So, and plus our export is currently around 47-50% of the total formulation revenues, the formulation exports, that is. So we definitely, and we have a lot of
Right. We were getting some more details from the management. Unfortunately, there was a glitch in the feed, but we did get the management's confidence of getting mid-teens volume growth, margins upwards of 14% in the next year. And hopefully formulations business also picks up as they've gotten out of the regulatory, or they've gotten regulatory clean chits from the US, and that will impact some of their business in the Europe positively as well. The stocks moved to the high point of trade on the conversation that has come by from the management, though the first 9 months of this year have been rather weak for them, and they will struggle to reach last year's revenue this year as well. But